GDP growth in Thailand slowed further to 1.5% year-on-year in the first quarter of 2024 compared to 1.7% in the fourth quarter of 2023. The biggest drags to growth came from the public sector spending and net export contribution. Nevertheless, we expect GDP growth to improve to 2.8% in 2024 compared to 1.9% in 2023, implying growth momentum to pick up in the coming quarters. Much of the improvement will come from a bottoming of the global electronic export down cycle, which we expect in the first half of this year. Higher government spending following royal endorsement of the FY 2024 budget in late April, as well as a solid recovery of the tourism industry. In terms of the fiscal profile, the government has revised higher its medium-term budget plan higher to account for wider deficits to support its measures. The fiscal deficits from FY 2024 until FY 2028 are noticeably higher, with the biggest adjustment for FY 2024. There is a good chance that some of these expenditures, if unspent, are rolled over into Budget 2025. This will coincide with the Digital Wallet program that is set for implementation in the fourth quarter this year. The program is expected to cost the government 500 billion Thai baht, or 2.7% of estimated nominal 2024 GDP. The government anticipates growth will be boosted by 1.2 to 1.8 percentage points in 2025. For now, the FY 2025 to 2028 deficit is pegged at 3.1% of GDP versus 3% of GDP previously. The focus of government policies has been to boost consumption spending and support the tourism sector. However, given the structural constraints within the Thai economy, there needs to be a rebalancing of expenditure priorities in our view. The structural constraints include a rapidly aging population, which will need fiscal assistance over the medium term to support pensions and healthcare costs, reorienting economic activities across the country as Bangkok and vicinities remain the largest contributors to growth. At the same time, focusing on providing incentives to the electronics export sector to allow it to move into the latest technologies for AI and semiconductors. Moving on to inflation. Inflation in Thailand has largely been subdued, coming in well below Bank of Thailand's target range of 1 to 3%. This was largely driven by government's fiscal and quasi-fiscal policies to cut retail diesel and electricity tariffs for an extended period. Since then, inflation has edged higher following the expiration of fuel subsidies. With the first half 2024 headline CPI averaging 0% year-on-year, we see downside risks to our full-year forecast of 1.2%. Looking ahead, our forecast is still for headline inflation to return to BOT's 1 to 3% target range around the fourth quarter, driven by higher retail fuel prices. At the same time, we have also seen core inflation pressures remain subdued. BOT's view of high inflation and better growth in the coming months has led it to keep its policy rate unchanged at 2.5% in the first half of this year. This despite significant political pressure to reduce the policy rate. At any rate, the public dissonance between the BOT and the government has hurt Thai assets, including the Thai baht and equity markets. The political pressure on the BOT is unlikely to subside and could weigh on sentiment even as the current account surplus narrows. We expect the current account surplus to narrow to 0.6% of GDP for the full year 2024 as stronger goods imports more than offsets strong tourism inflows and the recovery in goods exports. The BOT will likely remain nimble in terms of its approach to evolving growth and inflation outlook. Our baseline remains for the BOT to keep its policy rate unchanged at 2.5% for the rest of 2024.